Welcome back to Factful Finance, where we break down the numbers to help you make smarter financial decisions. Today, we're diving into one of the biggest headlines on Wall Street. The stock market has just lost $4 trillion in value. Is now the best time to buy, or is this a red flag signaling deeper trouble? Let's explore. Imagine you've been watching the market rise steadily, thinking it's a great time to get in. But then, boom, just like that, we've seen a huge dip, and suddenly, you're wondering if it's time to act or wait. Does this sound familiar? Well, you're not alone. Over the past few weeks, the stock market has taken a massive hit, with the S&P 500 down nearly 9% from its peak, and the tech-heavy Nasdaq even deeper in correction territory. This massive loss has many investors in a state of uncertainty. So, is this a chance to buy low, or a signal that things could get worse before they get better? First, let's break down what's happening. The market's drop isn't random. It's tied to significant political and economic events. A lot of the volatility stems from trade tensions, especially the ongoing tariff wars with key trading partners like China, Canada, and Mexico. These trade wars have caused serious uncertainty, which has impacted everything from corporate earnings to investor sentiment. Major companies like Delta and Tesla have seen their stock prices dive, with Tesla losing more than $125 billion in value in a single day. So, what does this mean for investors? For one, it's a reminder that markets can be unpredictable. What goes up can come down quickly. But does that mean it's a bad time to buy? Not necessarily. Let's turn to the data. Historically, market corrections, when stocks drop by 10% or more, have been followed by significant rebounds. In fact, according to data from the Federal Reserve, the market has recovered from every major downturn in history. The key, however, is knowing when to act. Now let's talk about what you can do as an investor right now. There's no one-size-fits-all answer, but here are a few things to consider. 1. Buy the dip, but with caution. If you have a long-term investment horizon, this could be a great time to purchase stocks at a discount. But don't rush in without a plan. As of now, the market's price-to-earnings (PE) ratio is still above historical averages, meaning some stocks may still be overvalued, even after this correction. This means picking your spots carefully is key. 2. Stay diversified. This is more important than ever. If you're looking to weather volatility, make sure your portfolio is diversified across various sectors. Defensive sectors like utilities and consumer staples tend to perform better during market downturns. Meanwhile, tech stocks, especially the mega caps like Apple and Nvidia, have been taking significant hits lately. 3. Be prepared for more uncertainty. The reality is that we're in a period of heightened uncertainty. As we see with the Trump administration's tariff policies, it's hard to predict what will happen next. If you're risk-averse, this might be a good time to reevaluate your exposure to volatile assets. Now, you might be asking, how do I know if this is a short-term blip or the beginning of something bigger? That's where you need to think about your personal financial goals. If you're investing for retirement, you might be able to ride out the storm. But if you're looking to make short-term gains, this could be a riskier environment. Let me introduce you to Liam, a viewer who reached out asking for advice during this market correction. He was concerned that his investments might lose more value, but after we went over his risk tolerance and time horizon, we realized that his portfolio was actually well-positioned to recover. He decided to stay the course, continuing to invest steadily in low-cost index funds. Or take Henry, another viewer who's looking to buy his first stock. With a smaller risk tolerance, he's decided to put his money in defensive sectors like utilities and consumer goods, which tend to do better in turbulent times. The key takeaway? The market may be down, but it's not out. Whether or not now is the best time to buy depends entirely on your financial situation and your risk tolerance. But if you're able to think long-term, buying during a market correction can set you up for big gains in the future. Before I let you go, I want to hear from you. Do you think it's time to buy or wait it out? Let me know in the comments below. I respond to as many as I can. And if you found this video helpful, don't forget to hit that subscribe button. You won't want to miss what's coming next. Stay smart with your money, and I'll see you in the next one.